If there is one question that's tormenting many people who are just getting started with investing, it's this one. Should I go with the S&P 500 or a global index fund? This is a question that many of you have asked me in the comments, and to be honest, I get it. Ideally, we'd all want to be investing in the best option. But as always, the answer is not just as simple as which one performs best in a chart. It's a bit more layered than that. And so to answer this question once and for all, I present to you today's video. In this video, we'll go through what each fund actually covers, an analysis of their performance, the hidden risks associated with each index, and many more other considerations. Throughout this video, I will also share how I applied what you'll be learning soon to my own personal investing journey. Before we dive in, as always, this information is not financial advice, and when you invest, your capital is at risk. So always practice due diligence when investing. All right, let's dive in. Now, just in case you're not familiar with either one of these, let me give you a quick intro to each one of these indices. Now, to start with, it's worth pointing out that both of these funds are well-established funds. The difference between the two is that the S&P 500 is only in the US market. It's made up of the top 500 American companies like Amazon, Nvidia, Apple, and so on. And part of what makes the S&P 500 so great is that it's passively managed, meaning that any companies that do well in a certain quarter get pushed higher and higher in the S&P 500 list. And the weighting of that company in the overall index increases. In a similar manner, if a company doesn't do so well, then the ranking of that company gets pushed down the list. And if the ranking of that company declines to the point that it's no longer one of the top 500 American companies, then it simply gets completely removed from the S&P 500. And that way, you as the investor don't have to worry about doing all of this yourself. There is no need to pick companies and analyze financials and pick which ones to keep and which ones to remove. It's all done for you, my friend. Now, on the other hand, a global index fund also operates on the same principle. It's also market cap weighted and passively managed. The only difference, as you might imagine, is that it covers the entire global stock market, which in itself is separated to two sections: the developed world and the emerging markets. The developed world being places like the US, Canada, Europe, and the UK, and emerging markets being places like India, Brazil, and China. Now, when we talk about a global index fund, we normally talk about indices like the FTSE All World ETF or the MSCI World Index. And most ETFs that track the global index will often track one of these two indices. In 2023, the global stock market has produced an annual return of 17%. In that same year, the S&P 500 returned 19%. In 2024, the gap was even bigger. The global index at the time returned 20%, whereas the S&P 500 returned 27%. In 2025, however, there was a change in leadership. As of today, the S&P 500 has a year-to-date return of 14.7%, whereas a global index such as a FTSE All World has returned so far 18.7%. This brings me nicely to the first problem in the S&P 500 versus global index debate. If we look at this graph right here, you can very clearly tell that the S&P 500 in recent years is flying on a rocket ship in comparison to the global index. And this is where the temptation of seeing this and going straight for just the S&P 500 can sometimes be misleading, and this is why. If we look back at this chart one more time, notice how only until the last decade or so that the S&P 500 started rising dramatically in comparison to the MSCI World Index. And I wish I could find even more historical data to further stretch this in the past. But at the moment, I only have data for the last 25 years. And throughout those 25 years, this entire period here clearly shows an almost identical performance between the S&P 500 and the MSCI World Index. If you had been an investor in the early 2000s, I don't think you'd have been fussed about which one to pick. But for new investors who are starting at this era of American dominance in many sectors in the economy, especially technology, it wouldn't surprise me if you just looked at the chart from before and just automatically assumed that investing in a global index fund is a bit simply because you wouldn't get the returns as fast as you would with the S&P 500. And don't get me wrong, it's absolutely okay to have a strategy where you are happy to take some concentration risk and volatility in the short term for the sake of higher gains. I've personally done that in my investing journey. And if you are a regular viewer of this channel, you probably would know that I'm a big advocate for both the S&P 500 and the global index for all types of investors, whether you are a beginner, an intermediate, or a little bit more advanced in your investing journey. However, this strategy does come with a cost. a very expensive one which does not have to do anything with numbers. It's a cost that by far has the most detrimental effect on your long-term returns. And this is what I like to call the peaceful sleep at night effect. If the cost of putting a 100% bet on the US stock market now means you'll be constantly worried about whether the US will keep its global dominance or whether China will come up with some sort of crazy technology that will replace its US competitors, or whether the top companies in the S&P 500, which influence almost a third of the entire index, will now suddenly lose half of their value following one news outlet, and all of this pushes you to constantly mess around with your portfolio and sell things here and buy them back later, or perhaps rebalance a few things here and there, then that act of constantly tinkering with the portfolio has a far greater negative effect on your returns than the choice between the two funds will ever have. Now, is it likely that the United States of America, the most powerful economy in the world, will suddenly lose its edge anytime soon? Probably not. But I also want to acknowledge that recent years have been a really good reminder to us as a human race that we have a golden medal at completely ignoring crazy sounding events. Until they happen.
A moment of silence for dear departed BlackBerry. Starting today, the BlackBerry classic device, once a go-to for millions, including then President Barack Obama, will no longer work.
From this evening, I must give the British people a very simple instruction. You must stay at home.
And so, going back to the peaceful sleep at night factor, one of the biggest advantages to a global index is that you as the investor do not have to worry about which global economies will rise in the next few years and which ones will decline. By choosing a global index, you are putting your bet on the entire world to continue growing economically. And it's not like you're gonna miss out on the super fast gains of the US stock market. The global stock market is already more than 60% concentrated in the US economy, and the top companies in the S&P 500 are pretty much the same as top companies in an index like the FTSE All World. Now, to help you with a realistic feel for a journey of a regular investor, I will share my own personal journey of how I approach the choice between the S&P 500 and the global index at different stages in my life. And of course, I'd like to reiterate my message from earlier, this is not direct advice, nor to imply in any way that this is how it should be done. I'm just a regular bloke who once upon a time discovered the very deep world of investing in personal finance, fell in love with it, and after a while started making videos about it. But back when I started, I was predominantly focused on the US stock market. I even took that an extra notch and invested in individual stocks, particularly focused on the top performing companies of the S&P 500 and in the tech sector. Companies like Nvidia, Apple, and Amazon. And I can tell you, throughout my journey, although I've made a lot of gains in recent years, I can imagine the level of emotional torture that somebody would feel for having such a US tech concentrated portfolio. The ups and downs would definitely be seen as dreadful for many people. And just to call out a few events from the last year and a half or so, I went through the Fed's cutting interest rates back in September 2024, which had a direct effect on the stock market, the crash of the Japanese yen, the bull run after Trump's election victory, the big sudden hiccup in the US stock market after the rise of the Chinese app DeepSeek, which troubled a lot of AI companies in the US, and most recently, and this is by far the most impactful event of the year, Trump's tariffs around the period of March to April 2025. Now, of course, events like these will be visible to any investor, whether you are invested in the global economy or in the US stock market only. But the fact that I was 100% on the US at that time just meant that the intensity of the rise and drops was much higher. And so, as you can see, events like these, and by the way, events like these will continue to happen today, 5 years from now, 10 years from now, and 20 years from now. This is just the reality of investing. It's a tax that all of us as investors have to pay to enter this world. But you can see that all of these events can be very easily potential triggers for many investors to start tinkering with their portfolio. And as I said earlier, this is the most impactful thing. If you can get one thing out of this video, is that you really don't need to worry about making the wrong choice between the S&P 500 and a global index. And I know that many people are afraid to make quote-unquote the wrong choice. But honestly, I think both approaches will likely lead you to the same outcome you desire in the future. It's part of why many of my investing experiments that I do to help beginners get started with investing tend to just focus on picking a simple fund like the S&P 500 to get started with. And in other videos which are targeted to a little bit more experienced investors, I tend to go through more advanced strategies with investing in a global index. But at the end of the story, both approaches will get you to a similar goal. What's not going to get you to the goal, however, is picking the option that intensifies the emotional triggers that cause you to start buying and selling constantly. Part of why I managed to outperform the market in recent years, and this is something that I don't expect to do in the long term, was that I resisted the urge to mess around with the portfolio at times where messing around with the portfolio was very tempting. And now if you take a look at my Trading 212 Stocks and Shares ISA account, you can see that I have multiple pies, and that first pie is my main portfolio. And now my main portfolio is held in global index funds. The other pies that I have there are what I call experiment pies, and I mostly have those for YouTube videos, where I just experiment with investing a set amount every month or every day, and I just share the results on this channel. And for those, I mostly tend to do them with the S&P 500, mainly because it's a simple, cheap, and easy to understand index fund. And by the way, if you do wish to use the app as well to invest in these funds, I'll leave a link and a promo code for you in the description. And for full transparency, this is an affiliate link, meaning that both of us will benefit from it. You will get a free fractional share worth up to £100, and I get a small commission that would help this channel grow and make better videos. Anyways, now, there is another consideration that we haven't talked about, which is fees. Obviously, we already know that the S&P 500 is constituted of 500 companies. And as a result, the admin burden is less, and that translates to less fees for investors. If we take some real funds, and let's, for example, take the Vanguard S&P 500 fund, this particular ETF currently has a 0.07% fee, which is very cheap for an ETF. On the other hand, let's take, for example, the FTSE All World, the Vanguard FTSE All World ETF to be more accurate, and this is an ETF that tracks the global index. The current charge figure or fees for this fund is 0.19%. And this is understandable given that this fund is tracking more than 3,000 companies. So basically that means more management requirements, which in return unfortunately translates to higher fees. I know fees are very important when it comes to investing because as your portfolio grows, the less you pay in fees, the more money you have to compound. But as I said, it really does not matter if you pick a cheaper fund if you're going to end up selling that fund a few months down the line. And in our journey to answer the question of this video, I did not cover so many other things. We haven't talked about the overvaluation of the US stock market, sectors exposure, and currency risks. Part of it because I don't really believe if I just throw as much information as I can at you, it's just going to help you with making a better decision. Because sometimes simply less is more. I will repeat this again. It's probably not going to matter which one you pick in the end as long as you satisfy one condition. Pick the one that makes you sleep better at night. Sorry, I'm recording this video after recovering from a cold, so please bear with me, and I apologize if I sounded a little bit off in this video. Sacrifices for YouTube. Perhaps you could help me out with a quick subscribe. And if you ever wanted to ask questions about these particular topics, then at the moment I have a community that I'm planning to launch soon. If that sounds interesting, then there is a waiting list that you can join by scanning the QR code here on screen or by clicking the link in the description. Thank you, my friend, and have a great day.